Powell signaled a fundamental policy pivot yesterday. The focus is shifting from fighting inflation to protecting jobs now. The balance sheet runoff is set to end completely by September, and rate cuts could potentially begin around October. These policy transitions, they tend to create measurable volatility patterns. Institutional traders, they anticipate these moves, while retail investors often react a bit more emotionally. Short-term cycles turned sharply higher on Friday. Momentum cycles, they reversed from being deeply oversold. But here's the thing, intermediate cycles haven't stabilized just yet. The long term remains firmly in the upper reversal zone. While a recovery is developing, it's not fully confirmed. Choppy action is likely to continue until we see that confirmation. Still, context can transform all this chaos into a readable roadmap. Price rebounded from the 25-day lower band. There are 4 crossover setups showing a bounce developing, but those early 3/5 averages haven't turned higher yet. That signals some caution, despite the current strength of the bounce. Timing indicators, they provide a nuance that price alone just doesn't have. It's all about having a readable structure, instead of making emotional guesses. That's the institutional edge that retail traders consistently miss. Institutions, they were already positioned before Powell spoke. Cycles actually showed the setup developing weeks in advance. Retail, on the other hand, tends to react after the headlines hit, and it's usually in an emotional way. Volatility, it really just represents repricing at different speeds. The knowledge gap here creates wealth transfers systematically. Constructive volatility at oversold levels creates opportunity, while destructive volatility at extended levels signals risk. If you're ready to trade with more discipline, clarity, and confidence, and maybe even predict the market days or weeks in advance, then join the Market Turning Points community and visit stockforecasttoday.com.